Welcome back. This is SeeWing Yi from the Yi Real Estate Network, and I'm going to ask you to compare a apple to apple comparison numerically, if you will. So the question is, the traditional retirement formula as provided by Wall Street and their financial planners, they usually recommend the threshold of you need about around $1 million to retire comfortably. And they also use this traditional formula of 4% withdrawal rate. This means if you withdraw 4% from the $1 million traditional IRA portfolio at retirement, whatever your age is, uh, that 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 drawdown, the monthly uh, income you produce, you will never run out of money for the rest of your life. Preservation of the principal. Okay, that is the traditional thinking. But I'm gonna use my own retirement methodology and try to use a rental property portfolio uh, to potentially retire with not only with more monthly income, with less of your capital required, but your retirement income could increase during retirement and thus have more flexibility. So with that in mind, just stay tuned. The I'm going to produce a lot of very, very exciting information which you may not be aware of because whatever, because of Wall Street, I guess. So here we go. All right. Very interesting. So income property versus traditional IRA portfolio for retirement. Okay. Uh, that's the distinction. Okay. And at the end of this video, then you have the ability to decide for yourself what type of investment model you wish to pursue to achieve your so-called financial freedom, lifestyle, and goals based on the numbers. All right. So again, this is the 4% rule. So the way I look at it, why the size of your nest egg matters less than how efficiently it produces income. What I mean by that? Well, we could find out. The 4% rule is not a myth, and it's not a magic number either, right? The ancient Wall Street rules, yeah, you need $1 million retirement at 4% withdrawal equals $40,000 a year income, right? For the rest of your life, you never run out of principal. That's the traditional rule. But I would say those kind of rules are perhaps are overstakes the certainty that the research never claimed. Okay? And you may ignore the taxes on the withdrawal. A lot of you have IRA portfolio. The withdrawal, even at age 59 and a half or older, is pretty much taxable, right? Right? And presumably, when you retire at age 65 or older, presumably your tax bracket are lower. But that's a wrong presumption these days, right? Often, a lot of people during retirement, their income, even without a W-2, could be higher than when they're working with a W-2 prior to retirement. So you never know. So you might even think about the traditional retirement formula that was developed decades ago may not apply to the modern world, right? As we live in, as we move beyond this year in 2026 and beyond. So another significant factor is a lot of this traditional retirement thinking, they ignore inflation. Inflation erodes the purchasing power. So the accurate vision is a retirement planning built on historical portfolio research meant it's just a mean as a starting point. It's not a guarantee. So it all depends on a lot of factors. I mean, on the risk involvement, your traditional $1 million portfolio. Usually at retirement, you take a less of a risk tolerance. You can rebalance your portfolio from stocks into bonds and money market, and what have you, in order to preserve your principal as you draw down your monthly income per the 4% withdrawal, right? So you don't want to take too much risk. You want to preserve your principal for the next 20, 30 years of retirement, if you will, right? Because longevity, people are living a lot longer, so they want to make money last longer than the life instead of did I say it right? Yeah. So yeah, okay, let's continue. So it's not the size of the number, it's about what the number does. So the question isn't whether 1 million is enough to retire. The question is how efficiently your retirement capital can produce the income. Okay? So your capital is how much you invest to generate the monthly or annual income stream. Two, the efficiency, annual cash flow produced per dollar invested. Number three, yield, the real comparable measure of retirement income performance, right? So let's use a very, very simple apple to apple comparison. Let's say you have $175,000 right now. I know I'm not saying you're going to retire with only $175,000 at age 65. I'm not using that scenario. I'm just adding, giving your age, giving your financial plan, whatever it is, I'm going to use a apple to apple comparison. I'm just going to use, you're not ready to retire. Okay, we're going to use this $175,000 stock market portfolio versus using the same $175,000 to buy an income property with leverage, with a financing, with loan. Okay, two potentially two very different outcome. By the way, I'm not a licensed tax advisor or financial advisor. This is my disclaimer. I'm not giving advice because again, I'm not one of those individuals. So therefore, this is for educational purposes only. Please consult your own licensed financial advisors to go over your situations, your risk, your goals, your risk tolerance to go over your situation. All right. So this is for educational purposes only. All right. So let's continue. So with $175,000 portfolio, okay, doesn't have to be IRAs, could be stocks, mutual funds, or which is non-qualified, whatever, right? You have $175,000. That 175K, if you would have withdraw at 4%, monthly or annual rate, okay, your annual withdrawal on a stock portfolio, Wall Street traditional portfolio, without any kind of leverage is $7,000 a year. However, you use this $175,000 to put a 20% or 25% down payment to buy a $650,000 property. It's a duplex, for example, a co-living rent by the room model. You can potentially produce $60,000 of net positive cash flow after deducting the debt service and the total operating costs. Okay, with the same amount of money, 175K. Okay, because real estate gives you leverage, right? You're financing only 20 to 25% down payment, and the bank will leverage the remaining 80% to 75% loan to value, if you will, right? So apple to apple comparison based on $175,000 of money, traditional portfolio give you $7,000 per year, which is 583 $583 per month, even before taxes, at 4% withdrawal. By using the example of a co-living duplex at $650,000. I'll give you more details later, at $60,000 a year. Okay, $5,000 monthly net cash flow on the same amount of capital. All right, 8.6 times more annual cash flow by using income property as leverage as opposed to traditional stock market or IRA portfolio of equal amount 175K, right? So the next question is, okay, you're asking yourself, how can I reach the $60,000 annual passive income withdrawal at retirement or $5,000 per month? On a traditional portfolio, you need $1.5 million of capital at 4% withdrawal to target $5,000 per month or $60,000 per year of passive income withdrawal. However, by using real estate, I'm going to explain more. Okay, all you need is 175K. All you need is 175K using real estate as opposed to 1.5 million on a traditional investment portfolio. You have the same equal approximately the same monthly cash flow with passive income or annual. Too good to be true? Well, keep on reading, keep on watching, actually. So, actual cash flow depends on operating performance. I know this is just an illustration. When you buy a property, you have to consider the financing terms, the vacancy, repairs, property taxes, insurance, property management fees, utilities, capital reserve, the whole 9 yards. I get it. Okay, I get it. All right, but so the question isn't whether 1 million is enough to retire. The question is how efficiently your retirement capital can produce the income you desire. And I already proven to you based on $175,000 money, and now you don't need a million, you need 1.5 million to equal the monthly passive income retirement, where in real estate, all you need is the equivalent to $175,000, give or take, all right? Okay, drum roll, please. And the answer, right, is a co-living property. With a co-living property, you get financing. In fact, you can get a DSCR loan financing, which is debt service coverage ratio, where you do not need your W-2 or federal tax return to qualify, because the DSCR loan primarily evaluate the property's ability to generate sufficient rental income to cover his debt obligation, not the borrower's personal income. So, okay, so I'm not going to go over the details of this unique loan that applies to co-living investment by the room model, which is growing by leaps and bounds nationwide, right? Co-living rent by the room model is a new real estate asset class and was growing, skyrocketing by leaps and bounds all over the country. Okay, for the reasons that are very obvious. Okay, so here are the formula. You can review this on your own, but I'm gonna go on to the nuts and bolts of everything else. So DSCR loan, 20 to 25% down payment. You know, you have the requisite credit score, 700 or higher. You have the down payment available, which is verifiable. You have cash reserve, and you qualify with a DSCR loan without a W-2, without a federal tax return, right? The 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 the, the lender, the DRCR lender, they underwrite the actual property, and the actual property I'm showing you right now, coming up, qualifies for the DSCR loan with a very competitive rates. Okay, compared to the regular full doc investment loan out there. Okay, very little different interest rate. So it's a 30-year fix, right? It's a very good loan. This no doc DSCR rates. Okay. All right. So, of course, our co-living models that we're discussing, we are offering this in five different markets, potentially more later, and in the areas of growth, Jacksonville, Tampa, Houston, and more locations coming up. I know if you're not part of my channel, please like and subscribe to my YouTube channel so you can learn more about co-living investment models. We do it new construction. We do like 1 bedroom to 1 bathroom. So it's a very lucrative investment. It's really doing very well. So we have a brand new constructions, co-living properties. Okay, ground up specifically to take care of the workforce tenants, the working poor. The working poor will gladly rent your furnished room, a nice, safe, and clean environment, and co-live with other strangers very harmoniously, if you will, because we have to support, this living investment model have to support our pass split. Pass split is our marketing technology platform, and we also use co-living property management to manage our properties, regardless of where you live, long distance, short distance, out of state. You buy remotely, and everything is done for you. It's hands-off kind of deal. So you're gonna love this, and you can potentially scale to numerous co-living properties across different areas and still require very minimal of your time to manage your portfolio, so you can retire with freedom without needing a second job, without any brain damage, without stress. And so you delegate and you outsource. Okay, you delegate all the hard work to the local professional property managers, and you outsource your mortgage and debt obligation payments to someone called by the name of a tenant, your member, your tenants that are occupying these kind of rooms. All right. So this kind of market leads to, so you have 7 member tenants, okay, living at your single family home, uh, you know, with 7 bedrooms, private bathrooms, only 320K, 20% down payment, DSCR loan. This is a down payment. At the end of the day, your monthly net cash flow is almost $2,000. Okay, here are the pro forma. You can read on it on your own. You see the down payment and the monthly net cash flow, the annual net cash flow. You see the amazing difference because you're leveraging with a loan. That's why you need a lot less money to retire based on your projection of the monthly income, as I stated earlier during this presentation. Okay, and this formula is just absolutely crazy, amazing. I'm not gonna go over it. My other YouTube channels, I've discussed all the details of these calculations. You can pause the screenshot, digest these numbers. It is a amazing, attractive blueprint benchmark of numbers which exceed traditional rental properties, exceed better than short-term rental Airbnb, better than traditional long-term rental, better than mid-term rental, better than all the other real estate asset class out there. We have a 14 to 14 model, okay? New construction, 20 to 25% down payment, right? And the gross rent, is amazing, $14,000 per month. Gross rent, $1,000 per room per tenant, right? So you do the numbers. At the end of the day, $5,000 monthly net cash flow as a starting point, right? This cash flow going to increase along with inflation over time. So this income is going to increase even during your retirement, and it's not about risk tolerance. It's not about rebalancing your traditional retirement plan portfolio. This is income property. Because of leveraging, the returns are much higher than a traditional stock or mutual fund portfolio, which requires substantially more capital to achieve similar monthly or annual passive income. Do you understand? You see clearly the apple to apple comparison, what one investment methodology, income property strategies versus traditional Wall Street retirement, right? Right? And you could be at any age, doesn't matter, any background, lack of a risk investing experience does not matter because you're buying into our portfolio of turnkey 100% property. We have done all the vetted work for you on the ground in those locations, right? We find the right location. We did all the research, due diligence, all the zoning requirements, or our ability to put 7 or 10 strangers together in a harmoniously in one house, and they get along for the most of the time, believe it or not, right? So we have a proof of concept. It's been proven for the past 8 years on the research that are done by Past Split. Nationwide there are like 40,000 co-living rental units exist nationwide, and these kind of units are coming on board on a exponential basis. So beyond 2026, we could expect a lot more than 40,000 rent by the room co-living units all over the country. So everywhere. So this is an amazing real estate asset class. All right. So let's continue. Look at these numbers on this duplex. The numbers is off the chart. Look at the cash on cash return. Look at the cap rate. Look at the debt to coverage ratio. The minimum is one percentage point to qualify for DSCR loan. You have 2.67%, which way exceed the minimum requirement for DSCR qualification. So all the numbers make sense. We factor in all the debt obligations, all the expenses, vacancy factors, paying the past split fee, paying the property management fee, paying for the utilities, furnishing the property, everything come out of your pocket, and yet you still net on this duplex almost $5,000 per month. This is just a projection, right? Based on all these numbers. So this is how we underwrite the property and etc. Okay, we have Houston. Had to go real fast. We have co-living new construction property coming up in Houston, 10 bedroom, 10 bathrooms. Look at all these numbers, which is crazy, right? Look at the net cash flow, annual passive income. So I have to speed up. Tampa, similar situation, brand new, best neighborhood, just turnkey. You can live anywhere in the country, in the world for that matter. And most of our buyers come from out of state, out of the country, and they are entering into this very lucrative co-living space. Rent by the room is a win-win situation. Is a win for you as a landlord because you're earning a lot more returns as opposed to regular properties. And the renters, the workforce tenants, they're happy because they are reducing their housing costs, rent by the room. Otherwise, they cannot afford. They otherwise this kind of workforce tenant they cannot afford even a one-bedroom apartment in their market, which is plus we provide all the furnishing, all the internet as landlords, as hosts, and internet, utilities, garbage pickup fees, water, everything else as landlord. We provide all the furnishing. So the tenant all they pay is $1,000 per month, and they can move in quickly into our rooms through past split marketing, and all they need is to bring their toothbrush, pretty much. Okay, very very simple process, and the returns are very very high. Of course, there are some challenges, but I don't have time to go over that. So, all right. So and then we have a fourplex, quadplex come in. This is a co-living property on steroids. On steroids, we are going to have a quadplex coming up in Jacksonville, Florida, by one of our esteemed builder, who's of course is entering the co-living space. They've been doing build to rent for many decades in Florida. Now they are slowly venturing into co-living new construction to support my companies, my network. And this is not official, but 920K fourplex, 20 bedroom, 20 uh, 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 private bathrooms, 1-to-1 ratio, which is amazing. This is the blueprint of the formula of the architecture coming up in the next few months. And this property is estimated to be 920K. Rent $1,000 per room, which is $20,000 per month. Gross rent $240,000 per year. Gross rent, which is absolutely incredible. If we incorporate the leveraging aspect of it, we incorporate the tax benefit with the cost segregation, the whole 9 yards. At the end of the first year, you may even get a return of 113%. You can recoup all the down payment money at the end of the first year based on paper, and your down payment is only about 200 grand total to finance this property to get $7,600 monthly net cash flow and $92,000 annual net cash flow after deducting the debt obligations and the operating costs and the vacancies and the upkeep and all that, the whole 9 yards. Okay. So this is some of our construction in progress. It takes about 6 to 8 months to build out the new construction for you, right? Because that's how it is. So at the end of the day, you spend 1 to 2 hours per month in managing your portfolio at the comfort of your home, regardless of where you live. Anywhere in the country, you can do this. So we have a system in place. We've been doing it for many, many years. We've been doing traditional, we continue to do traditional new construction properties, and we are venturing, increasingly into the co-living new construction model. And so we believe we have the best co-living type of properties anywhere in the country, bar none. And of course, this is our network is a one-stop shop. We provide all the services for you. We have done all the research, like I said, so you don't have to. We have all these tools and resources available for you as part of our network. The whole 9 yards, right? You have three options: do nothing, do something on your own, which is very, very challenging, of course. We have done all the most of the work for you up front. All you gotta do is pick our turnkey model, 100% turnkey, and um, it's truly a hands-off investment, right? So you don't need a second job, so you can focus on what's important to you around your retirement lifestyle. Okay, live your life in your own terms, and of course, just contact me if you're really motivated. We can do a complimentary consultation to go over your goals, to see if you're qualified, if you're motivated. Then we can work with one-on-one. We provide coaching and mentoring. So you're not doing alone, you're doing with a team that's been around for many, many years. Our team, our builder, our network, our turnkey providers, they've been around for years in Florida and Texas market. So you're in good hands. So at the end of the day, so to recap, okay, you can use a traditional method for retirement, okay? And as I already explained to you, requires a lot more money to achieve the desired monthly income based on the traditional Wall Street retirement, if you will, right? Versus using the power of co-living properties, the amazing up and coming real estate asset class. We're using leverage, using DSCR loans, using much less capital to produce very, very high return. So again, $175,000 down payment on a duplex 650K will produce $5,000 monthly net cash flow, $60,000 annual cash flow, versus you need $1.5 million to achieve the same amount of monthly income based on 4% withdrawal rate based on traditional Wall Street formula. So again, I'm just giving you some amazing education and knowledge so you can make an informed decision to determine if you want to incorporate co-living new construction model, very, very lucrative, into your retirement portfolio before it's too late. Okay, thank you so much. Once again, if you receive value from this presentation, please like and subscribe to my YouTube channel, and also put your email into my email newsletter inbox on my website below you, so you can become a free member of our network of like-minded real estate investors. We have several thousand members, and you learn about every week. Free content's going to enter your email. You learn more about co-living, more about investment opportunities we have in the whole 9 yards. And other than that, if you're truly motivated, you're ready to go, you really love these co-living strategies, you are closer to retirement, you have the capital, you have the motivation, you have the commitment, contact me directly for complimentary consultation, and we'll see whether we can work together to achieve to accelerate your retirement plans, right? Whatever that means. All right. Thank you so much. This is SeeWing Yi from the Yi Real Estate Network. I'll see you next time. Bye bye.